Okay, and I'm back. I'm sorry for the long gap in videos over the last 2 months. Life's kind of gotten in the way of me going out and actually looking at companies and actually doing valuations like this, so I apologize for that. The last one was rather successful too, so I kind of wanted to find something that could be just as successful down the road or something that interests me just the same as the last video. And also, life's gotten in the way. You have kids and things happen. So I apologize. I hope to get more videos out there over the summer, but I can't make any promises of that. But anyway, we're back. So this is a different company from ones I've looked at before. Today I want to look at CF Industries Holdings, and this is a agricultural play. So what CF Industries does is they manufacture and distribute nitrogen and phosphate fertilizer products worldwide. You may have seen them in the news recently. I believe they had a plant explosion down in Louisiana. So they're going through some tough times right now, but as a business, I found them to be rather interesting. The phosphate and nitrogen business, again, it's for fertilizer products. So we're talking about fertilizing farmland and lawns and things like that using ammonia, ammonia nitrate, and other chemicals out there. So they're competing with the Mosaics and the Monsantos of the world, I guess, for market share. They're a relatively new company. They've only gone public in 2004, but they've been around since 1946. So this may be one of those plays where following Buffett to the T is a chance where you're going to miss something, because what Buffett says is he likes to have 10 years worth of financial statements out there before he makes a decision. These guys only have 9 out there because they only went public in 2004. So this could be something where you can get in now, and then all of a sudden the value investors and the Buffett followers will finally pick up on it because they'll have enough information. But with that comes the risk that you don't have 10 years worth of data, so we have to make a valuation on that. Anyway, let's get to it here. As always, I like to look at the statements first. Actually, let's go back and let's look at the website first. So this is CF Industries, and this is what they do. They're distributing fertilizer, and they have all these various products out there. So urea, ammonium nitrate, yeah, that's probably exactly what it sounds like. Ammonia, ammonium nitrate, nitric acid. So it's a lot of nitrogen products and phosphate. And phosphate, believe it or not, the Tampa area in Florida is probably the richest place for phosphorus in the world. They call it the Bone Valley down there, and CF Industries has a presence down there. When I worked for a railroad, we knew all about the Bone Valley and how that operated down there, and how rich that was in these products. But anyway, they have their chemical products out there. They have plants and distribution all over the world, or I'm sorry, all over the country. Some in Canada. So you can see down here, Donaldson, LA, Alberta, Canada, Iowa, Oklahoma. So they have plants all over the place, and they do all kinds of different chemical products for the agricultural industry. Pretty simple, pretty straightforward business, but highly capital intensive. And as we're seeing with the explosion that just recently happened at one of the plants, it's also a very dangerous business, and that can be a good thing and a bad thing. And we'll look at that also in a bit. So okay, so let's go to the statements. So as always, let's go to the balance sheet, see what we got here. Looks like cash. See if here we don't have anything in 2003. So we're starting in 2004. Look at cash. Cash has significantly spiked up over the last couple years. So they're bringing in a whole lot of cash recently, which is always a good thing. Receivables seem to be in line and growing. Nothing too fancy with inventory. Seems like as they're growing their cash, it seems like inventory is just growing nice and steady. That's okay. Their fixed assets, they have grown their fixed assets quite a bit over the last couple years, from 600 million to almost 4 billion in fixed assets now. So they are a growth business. This is a growth opportunity. They also have some goodwill in here. This is where they've gone out and they've purchased other companies. I actually found CF Industries through on the old school value screen, but I also found them through another company I was looking for, looking at Terra Nitrogen, which CF Industries has recently purchased a large stake in. So from that company I was interested in buying, I was led down the road to CF Industries again through different avenues, and that's what really intrigued me, was that going through multiple different channels, you keep hearing the same name over and over again. And that's probably a good sign that they've got something good going. If you're looking for companies that are stable and their name comes up, you're looking for companies with growth and their name comes up. If they keep coming up over and over in these ways that you're looking at companies, it's probably a good sign that they're a pretty strong company. So when I heard their name a couple times through other things I was looking at, I was intrigued, and I looked a little bit deeper. So we see this goodwill here. It's grown over $2 billion in goodwill recently. So they've acquired a couple companies recently. So their growth has been based on somewhat on acquisition, which isn't necessarily a bad thing. When I was looking at Terra Nitrogen, it's a very cheap relative to earnings. So if they were cheap relative to earnings, and CF is cheap relative to earnings, there may be opportunity there to acquire these companies cheaply. So that may be a good strategy for growth right now, that they're not overpaying for acquisitions. We look at debt on the balance sheet. This is always the biggest thing that I look at first to rule out companies. Accounts payable looks like it's just kind of stayed. Looks like a big spike in 2010, but nothing too concerning relative to assets. Long-term debt. This is where things get interesting. They had no long-term debt for a long time, and as you know, I'm one that's a big proponent of no or low debt companies. However, in 2010, right around the same time as those acquisitions happened, at $2 billion in acquisitions, we've got $1.9 billion in long-term debt that was issued. So I'm guessing they financed their acquisition with long-term debt, and it seems to be tied together pretty well. And then they went out again and spent another $1.6 billion. Oh, I'm sorry. Then they went down. They paid down some of that debt. Now they only have $1.6 billion in long-term debt out there. Another concern may be this deferred income tax. They are deferring income tax. That's something they're going to have to pay down the road. But it seems like as that's happened, they've built up a cash reserve to handle those things. So it's not really going to affect cash flow of their operations. They have enough current assets to cover those debts. And it seems like their acquisition strategy makes a lot of sense when you look at the relative earnings power of the companies that they're acquiring in this industry. Retained earnings going up, that's a good thing. And you can see here right after the acquisition, there's a big jump in retained earnings. So they picked up a lot of income from these acquisitions and just organic growth. Okay, let's go to the income statement and we'll take a look at that. So as we said, we go back to 2004. So let's start there. Start at 1.65 billion in 2004, and it's just growth every year. And we all know I like growth, nice consistent growth. There's this little hiccup here in 2009, which is that economic turmoil. That's where I say I give a lot of companies a pass. They still did okay. I mean, they still were pretty close to their 2007 levels, but then they jump right back out in 2010. And then they double in 2011. Right after that acquisition, they've doubled. So revenue has grown significantly, almost tenfold. So the current 12 months, 5.9 billion, almost tenfold in the last 9 years. Revenue has grown. That's a good sign. There's a lot of growth there. Well, are they selling product at a good margin now? I mean, it's great to have revenue, but it's a good revenue. Look at their gross profit goes from 216. Jumps up over $1 billion, and we're up over $3 billion now. So gross profit has grown as well. Gross profit has grown more than tenfold. So you can see that while revenue's grown, they've actually gotten more efficient over the last 10 years. They were only at 13.1% gross profit margin. Now they're well up over 50%. And that would make sense in a capital-intensive business such as this. The bigger they are, the more economies of scale are going to play out in their model. So as they've grown, you can see that they've reaped the benefits of having economies of scale as they've grown, so they can use their capital much more effectively and spread out those costs over much more volume. So they are more efficient now. 52% gross margin is very nice, and it's been climbing, so that's a positive thing. SG&A seems to just be in line, nothing spectacular there. It's growing right along with everything else, but not as fast. It's grown maybe 3.5 times over the last 9 years relative to the 10 times revenue growth, and over 10 times, almost 15 times gross profit growth. So that's in line. It's growing, but not as fast, which is always a good thing. And depreciation seems to be in line as we talk about fixed assets growing and growing and growing. That seems to be in line. There's nothing too special there. Okay. Interest expense, obviously that's going to shoot up when they took out that long-term debt. Since they acquired everything and everything grew so rapidly in 2010, this interest expense seems like a pretty good deal that they only have to pay 135 million, 143 million a year to acquire such a large revenue stream and a growth opportunity there. So good deal there. I'm okay with this because of the growth that happened at the exact same time they purchased it. So yeah, I'll spend 135 million to pick up another 1.9 billion. That seems like a pretty good deal. Let's go down here. We can see earnings per share has grown also. That's nice. Really jumps in 2011. Must have got a really good deal on those acquisitions there. Okay, let's go to cash flow. So this is probably my favorite part, or second favorite part if you count the liability section of the balance sheet. So cash flow from operations, they were at 344 million, kind of dipped down, and then it jumps up to 609, and then it's just straight growth from 2007. So even though they had that dip in gross profit or revenue, cash flow from operating activities actually continued to increase over that time period, which is a nice thing to see. So cash flow from operating activities has grown 8 times, eightfold over the last 9 years. That's a pretty good growth record. I'm happy with that. I'm seeing growth, and I'm seeing not too much debt, not too crazy debt relative to their size. 10 billion in assets and 4.2 billion in liabilities. It's in line. It's okay, and most of it's in accounts payable and these deferred and accrued liabilities. It's not really long-term debt. It's other expenses that are out there, and they have plenty of cash to cover that those expenditures, and they have enough cash flow coming in. So looking at investing activities, there is a lot of capex. Here's that acquisition of 3.1 billion out there that they spent, and as we've shown, it looks like that's paid off quite nicely so far. Purchasing investments, sales, short-term investments, doesn't look like anything too weird out there, just kind of shuffling around some investments. Nothing too crazy. Capital expenditures, 612 million. I'm not too worried about that because of the growth and how big they are now. It has shot up significantly. Again, that's a 10-fold increase over, actually a 20-fold increase since 2004. But with the acquisition, that kind of makes sense, and this seems like a rather low number for what they were doing back then too. So I'm good with this. I'm okay. I'm comfortable. And what we're trying to do here is, when you're looking at all these numbers, is you're trying to get a comfort level on how risky you think the company is and how much growth potential you think there's going to be. Because really, that's what we're trying to do when we're doing discounted cash flow. We're trying to figure out what's the growth rate, what's the discount rate we need, and what's our starting point for cash flow. The starting point for cash flow is pretty easy to find. You just take the last year or the blended year. Those numbers are pretty readily available. It's the growth rate and the discount rate, which is a measure of the risk, that we're really trying to determine. And so far, what I'm seeing growth is phenomenal. I am really happy with the growth on this so far. And the discount rate's where we're going to have to make our decision here as we go through this now. So far so good. Let's continue on here. Looking at financing activities. How are they financing? Well, they issued a whole bunch of debt, paid back a bunch of debt also. So that's more of a refinancing around that time. I mean, the acquisition happened too. So net issuance of debt 1.1 billion. Doesn't seem too bad. They did issue stock also at that time. So there's how they financed the acquisition. Mostly, it looks like they They issued stock and they issued debt at the same time to finance that acquisition. That's okay.